What companies deserve your hard-earned dollar? Which would you want to work for? How can you know if they share your values? Just ask us. Just Capital is a nonprofit that tracks who really means business in supporting workers, customers, communities, the environment, and shareholders. We measure progress, track success, and help them be better. When you see the Just Capital seal, you know what's real, because just business is better business. Visit justcapital.com to learn who makes your dollar count.
Good afternoon. This is Mottek On Money, number one for your business and consumer news here on Talk Radio 790 KABC. This is Frank Mottek, and we're doing it live now, weekday afternoons at 4 o'clock. We get right down to business here with the news-driven hour. We're doing it more in 2024 and now at 4 in the afternoon. Mottek On Money live on the air on 790 KABC, streaming live online worldwide at KABC.com, and of course, your on-demand podcasts at KABC.com, Apple, iTunes, and all your favorite podcast platforms. And yes, on the socials, too. Look us up at Frank Mottek on X, formerly known as Twitter and Instagram. Well, here it is, January 17th, 2024. Our day started a lot better than it did 30 years ago. Everyone remembers what they were doing at 4:31 in the morning back in 1994 when we were hit by the Northridge earthquake. The building that I was in rattled like it was made out of cardboard. I heard about 1 million car alarms go off in the neighborhood. Of course, the phone and the power went out right away, and that's how the day started. Well, thankfully, we didn't have to face that this morning. On Wall Street, we did see stocks finish lower today as the market pulled back on expectations for this year's rate cuts following a stronger-than-expected retail sales reading for the month of December, which came out first thing this morning. The Dow coming in for a closing loss of 94 points. The S&P 500 ended down by 27, and the NASDAQ lower by just about 89 points. Looks like it was the worst day for the S&P 500 and NASDAQ since January 3rd. We keep track of all of this. We also got the latest report on the economy today from the Federal Reserve, the so-called Beige Book survey of economic conditions across the country. Signs that the labor market's cooling in nearly all regions of the country, according to that Beige Book survey. This is something the Fed will take a closer look at the end of the month to decide interest rate policy. The Beige Book contains insights about activity across the country. For example, in the Bay Area, communities continue to grapple with a widespread shortage of affordable housing. How's that for breaking news? Leading to increases in homelessness and housing insecurity. This is, of course, this is the Fed's latest assessment there on what's happening in the Bay Area. Sheryl Sandberg from Facebook, famously, and wrote that book, Leaning In. Sheryl Sandberg, the longtime chief operating officer of Meta Platforms, who left Meta back in September of 2022. Meta, of course, is now what Facebook used to be. After 14 years there, she's now leaving the company's board of directors. Sheryl Sandberg announced her departure in a Facebook post, will become an informal advisor to the company starting in May. Looks like Meta shares moved up about 1/4 point today. Distressed debt giant Oaktree Capital sees big opportunities in credit unfolding over the next few years as a wall of debt comes due. Watching what's happening with commercial real estate in particular, more than $1 trillion of commercial real estate loans are set to come due this year and next year, according to the Mortgage Bankers Association. Speaking of bankers, a big confab going on in Davos, Switzerland, including the head of the nation's largest bank, J.P. Morgan Chase, Jamie Dimon, said he still sees no value in Bitcoin and is done with talking about crypto after the first several Bitcoin exchange-traded funds debuted in the U.S. last week after getting approval from the Securities and Exchange Commission. He gave an interview on CNBC, said he was hoping it was the last time he talks about Bitcoin. We're also watching the price of oil with the situation unfolding in the Middle East as Israel and Hamas continue to fight, and also, of course, the latest developments in the Red Sea involving Houthis and clashes with U.S. naval vessels. Oil futures ending mixed today with crude oil prices finishing higher. And we see the price of oil today moving up by 16 cents at $72.56 a barrel. Brent crude in London, the global benchmark, down 41 cents at $77.88 a barrel. Production cuts by OPEC and allies have helped the market remain stable despite the rise in geopolitical turmoil, according to one senior market analyst at DTN Oil and Analysis. Well, China is warning the U.S. against escalating its attacks on Houthi rebels in Yemen as the conflict in the Red Sea increasingly threatens both Beijing's economic and diplomatic interests. We'll discuss that and also the latest news coming out of China's economy. China's economy last year grew at one of its slowest rates in more than 3 decades. Also, the Wall Street Journal had an interesting article here. New questions are being raised about what China knew about the early days of the devastating COVID-19 pandemic. I'll discuss the latest China news later this hour with our go-to China expert, Gordon Chang, author of The Coming Collapse of China and the Great U.S.-China Tech War. He's on X, formerly known as Twitter, at Gordon G. Chang. Rising Treasury bond yields putting the nation's eye-popping $34 trillion debt load back in the spotlight. We'll get an update this afternoon from Dr. Veronique de RUGY, the George Gibbs Chair in Political Economy and Senior Research Fellow at the Mercatus Center at George Mason University, nationally syndicated columnist. But first, on your money, the markets and the economy, geopolitics, politics, and the whole works on this Wednesday afternoon. Joining us live now is Paul DIETRICH, Chief Investment Strategist at B. Riley Wealth, based right here in Los Angeles. Paul DIETRICH, great to have you with us. Happy New Year to you, sir.
You too, Frank.
A lot to talk about here. It's our first conversation here in 2024, and markets seem to have gotten off to a rough start this year. A lot of moving parts here. Give us your view of things here at the moment.
Well, it seems like investors are of two minds. You know, there are those investors who kind of believe the Federal Reserve and believe what Jerome Powell is saying, that they're going to take their time, look at the data, and, you know, maybe near the end of the year we'll have some rate cuts. Most people, at least the Federal Reserve, has indicated 2 or 3 before the end of the year. But then there's another large group of investors who want what they hope what the Federal Reserve is going to do, and I think there are probably a majority of them who believe that the Fed is going to significantly cut rates this year, and they're going to start cutting in March, which isn't going to happen, and they've been driving the market up through the latter part of 2023, and now that a lot of people are starting to doubt themselves, as the Fed presidents are coming out one after another saying, hey, you guys have gotten ahead of your skis here.
All right. What about the outlook for this year? Are we in a recession already, or are we heading into one now?
We're heading into one. I'm not sure that we're in it yet. And you even just look at the Beige Book today, the Empire survey that the Federal Reserve released yesterday. What we're seeing is across the board an acknowledgement that jobs and job growth is weakening, and we're going to start seeing higher unemployment. At the same time, we saw the consumer sector did very well in December, and, you know, retail sales were up. But if you dive down into the data, what you're seeing is this was probably the last hurrah for big consumer spending. Almost everyone is talking about how consumers, now that the holidays are over, are pulling back. You're seeing it in figures like durable goods and big ticket items have really dropped significantly. People just aren't buying. And the reason is that they basically, after they got rid of their excess COVID stimulus savings, which I think, you know, pushed off the recession by about a year, after they spent all of that, they started spending on their credit cards. And what we're finding out is that there are many, millions of credit card users are hitting up at their credit limits as of the holidays. And that's going to force, we've seen this before, a dramatic drop in consumer sales as we go forward. And when you have rising unemployment and you have, you know, dropping consumer spending, which is 70% of the U.S. economy, that is the definition of a recession.
On the air live with Paul Dietrich, Chief Investment Strategist at B. Riley Wealth. And as you noted, that recent manufacturing reading we got this week, that Empire State reading the lowest since May of 2020. We all remember what was going on that year when the economy was shut down during the pandemic. That's how low manufacturing activity is now?
It was one of the lowest. It was lower than 2008, 9, and 2000 as well. I mean, we really have to go back to see that kind of decline. If you look at all the leading economic indicators, manufacturing, new orders, all of these things are down. And that's what most investors just aren't looking at, the real economy, the underlying weaknesses that you see by looking at the leading economic indicators that month after month after month keep declining further. And that's a real problem. And then I think the congressional debt, we're continuing to increase the debt. Over the last 4 years, we've added $11 trillion, which is all money that was not paid for. It was just printed money. And even though I believe that inflation, we're still going to see it come down, but we're starting to see core inflation. It was up this past month, and it's kind of moving sideways. I think it will go down, but with all this extra $2 trillion they've spent over the last 2 years, Congress has, and there's been no COVID, there's been low unemployment. Why in the world are we running up trillions of dollars in debt? At some point, that's going to turn. There's always a lag, but that's going to turn into inflation. And I'm afraid we're going to see that kind of 1970s, where inflation goes down as the Fed raises rates, and then they cut rates, and then inflation goes right back up again. And we called it stagflation back in those days, and it was not good for anyone.
Certainly, and something that came to mind recently, remember at the start of 1991, on the eve of the first Gulf War. In fact, I believe today happens to also be the anniversary of the day the first Persian Gulf War started, when the USS Wisconsin fired the first missiles against Iraq, opening the war following the invasion of Kuwait. Does it feel like those days as well? There was recession talk back then, and of course we're looking at military action now involving the U.S. and in the Red Sea against the Houthis, and of course Israel at war with the terror group Hamas at the moment.
I think it was Jamie Dimon who at Davos today said that he, in all of his years running the largest bank in the world, that he had never seen so many risks, both geopolitical, political in the United States, just the whole range of risks, all of which could independently negatively affect the economy. He had never seen so many in his life, and I tend to agree with him. 1991, I think 1973, when we had the first Arab oil embargo and we had a recession in 73 and 74, we're seeing patterns here. And, people have talked about a soft landing. I think we've seen the soft landing all during 2023 was the soft landing. And now we're going to have a recession sometime soon. People were talking in 1991, as you mentioned. There was a lot of talk. If you look at Bloomberg back in those days of their news service, there was a lot of talk about a soft landing. In the end, it didn't happen.
On the air live with our great expert here, Paul Dietrich, Chief Investment Strategist at B. Riley Wealth. And at this point, by the way, not to pile on, looks like the job market also starting to weaken somewhat. That's been one saving grace of this economy on paper anyway. Job openings, though, have fallen while continuing claims for unemployment benefits have been steadily rising lately. What are you expecting on the job front this year?
Well, every day, if you're reading the financial news, you're seeing another corporation, laying off 10,000 people. And the trend is there. And especially now that the holiday season is over, this is a generally a weak time and a time when, people start laying off people. But as business executives, CEOs are looking at those leading economic indicators, and you're seeing lower new orders, you're seeing manufacturing just drop off substantially. All of those things that affect the real economy and consumer spending, just simply because people are hitting their limits on their credit cards, they're doing what makes sense in a weakening economy. They're laying off workers. And as I said, when you have unemployment going up and consumer spending going down, that is effectively what causes a recession.
At this point, let me ask you the big question here. We ask any specific places where you are putting money now and or taking it off the table?
I think now's the time to, if you're a smart investor, now is the time to hunker down and protect what you have. This is not a time to be going into a stock market that is just so overvalued. It's not even funny. I mean, if you just go onto any kind of charting service for the S&P 500 and you look at the long, the 50-day and the 200-day moving averages, which are basically the mean averages of the stock market, we are so far above those trend lines that anyone who invests in this market right now is an absolute fool, because, remember what your grandmother told you when you were a little kid, buy low, sell high. If you go into market now, you're buying at as high as you can get, and it's going to be a disaster. So I believe that investors ought to get into a fetal position and just, be patient and protect what they have any way they can.
All right. And what about those Bitcoin ETFs? I have a feeling you agree with Jamie Dimon's comments that you don't want to hear about Bitcoin or talk about it anymore.
Well, there's no there. When you invest in Apple, there are real products. They have real estate. They have real manufacturing facilities. Those are never going to go down. That stock's never going down to zero, no matter what. And on Bitcoin, where it's nothing but an algorithm, there's no there, as I said. It's what we call the greater fool theory. If you can get someone to pay more than you paid for your Bitcoin, that person is the greater fool. If you can't, you know who the greater fool is. But it's legalized gambling. It's no different than going to Las Vegas and putting all your money, in roulette on the red or the black and letting the wheels spin. It's, it really is gambling. It's not investing.
Paul, thank you very much for sharing your always terrific insights with us here today. Look forward to many conversations with you in 2024. As we say here, we're doing more in 24 and hopefully have more conversations with you here in the new year. That is Paul DIETRICH, Chief Investment Strategist at B. Riley Wealth, based right here in Los Angeles. Paul, thank you very much for taking the call this afternoon.
Thank you.
And right after the freeways we go now here on 790 KABC. Friends, it's time to start the new year off right with reminders from attorney Clark Fielding of Fielding Law. Now, if you've been hurt in an accident that was not your fault, it's easy to feel lost in the sea of legal complexities. Fear not. Clark and his team of law sharks are right here to navigate the legal waters for you. They have the expertise to tackle any case, big or small. Fielding law is not just about providing legal advice. They're also about making sure you understand every step of the process. So consider them your partners in justice. Whether you're facing a sea of paperwork, swimming in contractual confusion, or caught in a legal undertow, Clark the Shark is the lifeguard you need. The Fielding Law team is dedicated to protecting your rights and ensuring a smooth journey through the legal currents. So as you dive into the new year, remember, Fielding Law always has your back. They're not just lawyers, they are your fantastic friends in the legal world. Call them now, 833-88-SHARK. That's 833-88-SHARK, or go to clarkthesharklaw.com. Again, that's clarkthesharklaw.com. Mottek On Money continues here in 790 KBC. 790 KBC welcomes the one and only Engelbert Humperdinck coming to the Saban Theater February 10th. Tickets are on sale now at AXS.com. Right now, caller 9 wins at 1-888-790-5222. You can get a pair of tickets to the show if you're caller 9. Call now, 1-888-790-5222. Mottek On Money continues here in 790 KBC. Good afternoon. We're doing it live here in the 4 o'clock hour now here in 790 KBC. Doing more in 2024 at 4. Live right here on the air and online, of course, at KBC.com and your on-demand Mottek On Money podcast at KBC.com. Lower finish for the market today with the Dow down 94 points, settling at 37,267. The S&P 500 down nearly 30 at 4,739. And the NASDAQ down nearly 90 points today at 14,856. The yield on the 10-year note has popped higher to 4.11%. Stronger than expected retail sales numbers right out of the gate this morning, putting upward pressure on bond yields once again. Apple shares pulling back nearly $1 today to 182 and change. Meta, formerly known as Facebook, moving higher by nearly $1 at 368 and change. Oil higher by 16 cents, 72.56 a barrel. Gold of $3 at $2,009.50 an ounce. Checking the cryptos now, Bitcoin up $2 at 42,685. Ethereum down 2 at 2,522, and Doge at 8 cents. And now the latest news for you right here on 790 KBC. Mottek On Money continues here on 790 KBC. Good afternoon. Good afternoon. We're doing it live in our new time in the 4 o'clock hour here on 790 KBC. Mottek On Money, weekday afternoons at 4 o'clock. Also streaming live online worldwide at KBC.com and the on-demand Mottek On Money podcast, of course, at KBC.com, Apple, iTunes, and all your favorite podcast platforms. Well, how's this for a credit card bill? $34 trillion. Yep, that's Uncle Sam's credit card bill at this point. The nation's eye-popping debt load back in the spotlight today as rising Treasury bond yields have people nervous. Let's get an update on all this now from Dr. Veronique de RUGY, the George Gibbs Chair in Political Economy and Senior Research Fellow at the Mercatus Center at George Mason University, also nationally syndicated columnist. Looks like the Senate, by the way, is racing to pass a stopgap spending bill before that big snowstorm really hits and a potential government shutdown at the end of the week. Happy New Year, Veronique de RUGY. Thank you very much for taking the call here this afternoon.
Happy New Year's to you, too, and thank you for having me.
Thank you. Yeah, well, you're right there in the eye of the storm, the snowstorm, as well as the political storm, as well as the debt storm there. Give us an update on all of this this afternoon.
The update is too much spending and just no fiscal responsibility for years. But in particular, the last, 10 years has been quite disastrous for our finances. And the real problem that we face is that while the U.S. has been able to pile on some debt without much consequences, especially the last 15 years, where interest rates were very, very low, historically low, that's not the case anymore. Interest rates are much higher. They're at least 4 times bigger than they were pre-pandemic. And we have a debt to GDP that's roughly 100%. And because so much of our debt is short-term, it means that actually the bills for interest payments are come due very regularly. And if we continue like this, we risk restarting inflation. Not that inflation has been conquered yet, but we risk actually having it picking up.
Absolutely. Very important points here, and I know you've written rather thoroughly about this in your Reason magazine column, Deep Reason magazine column. So how worse is it going to get?
Well, so the way the Congressional Budget Office project these things is that there are rules. It says that it has to do as if whatever is on the books is going to happen. It also has to say that when the Social Security reform, the trust fund and the Medicare trust fund are dry, and there's no more assets in there, Congress has to pay all the benefits with borrowing if needs be. And so, but it also makes projection for what interest rates may look like. And it also assumes, and often these are kind of rosy scenario on interest rates, and it also projects that there won't be any inflation. And under these circumstances, which are very unrealistic because it also projects no recession and no new spending programs and things like this, the debt to GDP ratio is going to reach 180% of GDP in 30 years. And I actually think that this is likely not going to be the case. I actually think that inflation is going to kick before, and that is going to keep the debt to GDP ratio much lower than 180% of GDP, but it's going to mean that the consequences and the conditions on the ground in America are going to be really painful, because effectively what the government is going to do is deflate that debt away. So this is why we have to be very careful about, looking at these projected numbers. And the reason why I think inflation is going to increase at some point, I don't know when, but and going to deflate the debt and create probably a debt crisis is because investors are going to be worried at some point that there's just not enough primary surpluses. So that's like the revenue minus the spending, if you exclude interest payments, to pay them back. And so they're going to worry about inflation, and the moment they worry about inflation tomorrow, we have inflation today.
And right now, it doesn't seem to be politically correct to say, hey, folks are spending too much money. Who is taking the lead on this issue there in Washington? And is anybody doing that?
No one, because a lot of the budget fights that you hear about are about what we call discretionary spending. So that's basically education spending, transportation, infrastructure, farm subsidy, and things like this, the Department of Defense. But really, the biggest part of the budget, 70% of the budget, is on programs like Social Security, Medicare, Medicaid, and a few other trust funds. These are programs that are growing on their own. Basically, they're not reauthorized every year. The amount of money that's paid out depends on the beneficiaries and the number of beneficiaries. And basically, they're set in stone. And this is where all of our future debt is. And so when they're having budget fights, they're not having budget fights over this. In fact, there's a remarkable consensus in Congress about not talking about this. The Republicans used to be willing to talk about this. I mean, there was a time where Representative Paul Ryan even put out plans to reform entitlement spending. But that now no one talks about this. So they're having these enormous fights about a part of the budget that even if you kept it where it is and even actually clean and got rid of all the stuff that is, fraud, waste, abuse, all of that thing that people like to talk about, we would still not be on a sustainable path, because the growth of our future debt are on the part of the budget where they're not fighting about.
Well, Veronique, thank you very much for watching out for the taxpayer here. And again, a reminder that it's not government money, it's our money that we're talking about here, that they are spending, and it's going through the roof. Your great article which can be found, by the way, at Reason.com, is titled "The Fiscal Hawks Were Right About Debt and Interest Rates. Rosy Fiscal Expectations Based on Eternally Low Interest Rates Are Proven Dangerously Wrong." Veronique de RUGY, the George Gibbs Chair in Political Economy and Senior Research Fellow at the Mercatus Center at George Mason University and nationally syndicated columnist. Veronique, thank you very much. We wish you all the best for the new year and look forward to speaking to you again soon.
Me too. Thank you. Bye.
Thank you very much. Bye-bye now, and let's get right out to the freeways here in 790 KBC. Mottek On Money continues here in 790 KBC. Good afternoon. We are live on the air here with Mottek On Money in the 4 o'clock hour now for you. Weekday afternoons at 4. Mottek On Money doing more in 24 at 4 o'clock. China's economy growing at one of its slowest rates in more than 3 decades last year, as it turns out, according to official numbers released by China itself today. Also, China's warning the U.S. against escalating its attacks on Yemen's Houthi rebels. This is interesting, as the conflict in the Red Sea increasingly threatens both China's economic and diplomatic interests. The Houthis' month-long campaign to restrict maritime traffic moving through key Middle East waterways is a particular threat to China, which is heavily reliant on the Suez Canal, as well as other waterways to move Chinese products to European markets. China also more dependent on the U.S. on oil and gas imports from countries including Saudi Arabia, the United Arab Emirates, Iran, and Qatar. Also, another interesting report out in the Wall Street Journal. New questions are being raised about what China knew about the early days of the devastating COVID-19 pandemic. Let's bring in our China expert on all of this now. China expert Gordon Chang, the author of The Coming Collapse of China and the Great U.S.-China Tech War, on X, formerly known as Twitter, at Gordon G. Chang. Gordon, thank you very much. Happy New Year to you, our first conversation here in 2024.
Happy New Year to you, Frank, and thank you so much.
Thank you, and a lot to unpack here. First of all, regarding this report on China urging the U.S. Not to engage with the Houthis against escalating attacks on Yemen's Houthi rebels. What's your reaction to that, and what are we to make of that?
I think that what we see is China supporting Iran, Iran supporting the Houthi militia. And so, of course, the United States, China is going to warn off the United States from attacking a proxy of a proxy. The Houthis are not going to shoot at Chinese ships. And so I don't think Beijing is terribly concerned about what would happen to their vessels. So really what we're going on here is China supporting one side in this war, and it is against the United States in all respects.
And it is to be noted, according to the report I see here, China declined to join the U.S.-led coalition of forces called Operation Prosperity Guardian, which began policing the Red Sea last month against those Houthi rebel attacks.
Yes, and again, China is trying to destabilize the Middle East. It's, I think, part of a larger plan to destabilize the world. Xi Jinping, who admired Mao Zedong, the founder of the People's Republic, actually said that chaos would lead to the eventual institution of worldwide Chinese rule. I think that Xi Jinping is just taking a page out of that peasant revolution playbook and hoping that the chaos spreads.
All right. What about the Chinese economy? I don't know if you saw those reports of buildings being blown up there, vacant apartment buildings. Remember during the financial crisis, we used to see, I think it was on 60 Minutes, where they were showing basically entire vacant cities there in China. They had built up their real estate and nobody was there. Now they're trying to blow these places up, apparently, to increase prices. P.S. China's economy grew at one of its slowest rates in more than 3 decades last year. Give us an update on what you're seeing there.
Well, first of all, with regard to property, a former deputy head of the National Statistics Bureau in September gave a speech, and he said that China has enough vacant apartments for its entire population of 1.4 billion people. Some people dispute that number, say that there's enough vacant apartments for 3 billion. The point is that there's an oversupply of property. The Chinese economy did not grow at 5.2% last year, even though 2022, the base year, was a disastrous year for China. We don't know how fast the Chinese economy grew, maybe 1%, maybe contracted 1%. But a country that is mired in deflation, and there's deflation in the consumer and in the manufacturing sector, it's just not credible to believe that they had such good numbers.
Right. You said deflation, not inflation, right? We did see, for those who follow this, it's significant. The yield on the 10-year Chinese government bonds hovering near record lows with deflationary pressures rippling through the Chinese economy.
Yes. Well, the consumer price index in December was down for the third straight month. For the entire year, they said it was up 0.2%, but that's not exactly credible. The producer price index, which measures factory gate prices, in December was down 15 straight months and was down 3.0% for the entire year, according to officials. Those numbers are going to be worse. It's countries in a deflationary cycle, and this is going to be hard for China to get itself out of, because Xi Jinping does not believe in jump-starting consumption. And so, therefore, I think China is stuck in a spiral downward, and it has no way to get out of it short of a crash.
And briefly on this other story, the Wall Street Journal this afternoon reporting that Chinese researchers isolated and mapped the virus that causes COVID in late December 19, at least 2 weeks before Beijing revealed details of the deadly virus to the world, according to congressional investigators, raising new questions about what China knew in the pandemic's crucial early days. Your response to that latest report?
It's been known for some time, for more than a year, that China mapped the genome of SARS-CoV-2. Sometime in late December, they actually prevented Chinese institutions from sharing what they knew about this. Clearly, Beijing was preventing the world from knowing. They did not tell the world that this was a contagious disease until January 20, 2020. Previously, they told the world it was not readily transmissible. And on January 20, they actually said, it's just a few cases in Guangdong province. They were lying from start to finish. They were, I think, deliberately trying to spread the disease because they knew that this was highly contagious. They told the world it was not. And while they were locking down their own country, they were forcing other countries, especially the United States, to take arrivals without restrictions. So this is maliciousness of the worst kind.
Gordon, thank you very much for taking the call on all of this afternoon. That's Gordon G. Chang, the China expert, author of The Coming Collapse of China and the Great U.S.-China Tech War on X, formerly known as Twitter, at Gordon G. Chang. Thank you very much for joining us live here. This is Mottek On Money on 790 KBC. Stay tuned now for the 790 KBC News Blitz with our legal eagle, Royal Oaks.
Business has always been about turning a profit, making money. But can it stand for something more? Something beyond dollars and cents? We think so. We think that today, business has a higher calling, a purpose to be fair and just, to do right by their workers, customers, communities, and the environment. And it turns out companies successful doing that also do better for their bottom line. When you see the Just Capital seal, it means this company is a force for good. Visit justcapital.com to learn more.